Today I'm going to teach you how to analyze a stock, and this is the second video in my Investing for Beginners series. I'm going to open a case with you on Yahoo Finance. We're going to look at some indicators and I'm going to explain what each of them means. That's it. And please subscribe to continue watching the next videos in the series. Thank you in advance. When you open Apple's page on Yahoo Finance, the very first thing staring at you is the stock price. Right now it's sitting around $229 per share as of August 21st, 2025. That's the headline number every investor looks at first. But here's the trick. The price alone doesn't tell you if the stock is cheap or expensive. A stock worth $229 could actually be cheaper than one worth $20. It all depends on earnings, growth, and valuation. That's why the next thing you check is the market cap, which in Apple's case is $3.34 trillion, making it the third most valuable company in the world. Then we have the bid and ask. Think of this like buying and selling on a marketplace. The bid is what buyers are offering. The ask is what sellers want. Since the numbers are close, it means Apple stock is very easy to buy and sell. There are always people trading it. Now the days range. Today, Apple has traded between $225.41 and $226.99. And the 52-week range, in the past year, the lowest price was $169.21 and the highest was $260.10. So right now, Apple is closer to the top of its yearly range. Volume tells us how many shares traded today. The average volume is almost 55,869,124 shares. So trading is still warming up. So everything we've seen so far are indicators that Apple is a huge company with a lot of liquidity, which means it's unlikely that you'll run into problems buying or selling its shares. Now moving to the beta, which is 1.16. Beta is just a way to measure how much the stock moves compared to the market. If the market goes up 1%, Apple usually goes up about 1.16%. That means it's a little more volatile than average, but still very stable compared to smaller or riskier stocks. For a beginner, a beta close to 1 is considered healthy because it shows the stock doesn't swing too wildly. Right below that, we see the PE ratio. This tells us how expensive the stock is compared to its profits. In Apple's case, investors are paying $34 for every $1 of profit the company generated in the past year. The average market PE usually sits between 15 and 20, so 34 is expensive. But the market accepts that because Apple has proven itself to be reliable, profitable, and still capable of growing. Ideally, you'd want a PE under 20 if you're looking for value. Anything above 30 is considered pricey unless the company has strong growth ahead, which is Apple's case. Then we have EPS, $6.59. This stands for earnings per share, and it basically shows how much profit Apple makes for each individual share. Higher EPS means more profit is being spread to shareholders. The ideal here is not a specific number, but a clear trend of growth year after year. If EPS keeps increasing, it's a sign that the company is getting stronger. Another important point is the earnings date, October 30th, 2025. That's when Apple will release its next financial report. These dates matter because stocks often jump or fall depending on whether the results are better or worse than what Wall Street expected. A good company consistently surprises to the upside, and that's what keeps investor confidence high. Apple also pays a dividend of $1.04 per year, which works out to a 0.46% yield. In simple terms, if you hold Apple shares, you get a small cash return every year. That's not a lot compared to dividend-focused companies, which often pay between 2% and 4%. But Apple prefers to reinvest its profits and buy back its own shares instead of giving big dividends. For long-term growth, that can actually be better than a high payout. The one-year target estimate is 234.17. This is what analysts predict Apple's stock will be worth a year from now. Since it's only a little above today's price, the expectation is for steady, not explosive growth. But don't take this number too literally, it's just an estimate. What really matters is Apple's ability to keep growing revenue, profits, and cash flow over time. But speaking of price, remember I just taught you what EPS and PE are? You can actually use a simple formula with these two indicators to check if the stock price makes sense. The math works like this. Price equals EPS x PE. Apple's EPS right now is $6.59 and its PE ratio is 34.35. If we multiply the two, we get about $226. Since Apple is trading at around $229, the market price is exactly where the math says it should be. That means the current price already reflects the company's profits and the valuation investors are willing to pay. But here's the catch. A PE above 30 is considered expensive compared to the market average of 15 to 20. To check if Apple might be overpriced, we look at the PEG ratio, which compares PE to growth. Apple's PEG is just over 2, which means the market is paying about twice what its expected growth rate would justify. If Apple were priced at a PEG of 1, considered fair value, its PE would be closer to 17. Multiply that by the same EPS of $6.59, and you'd get a fair price of about $112. So what does that tell us? It tells us that Apple is not cheap. Based strictly on growth, the stock looks expensive. But moving to the part 2, let's look at the company's health, because any experienced investor would tell you to look at the company before investing, how it makes money, and how it positions itself. When we move to Apple's latest report, the picture becomes clearer. In the quarter ending June 28, 2025, Apple announced revenue of $94 billion, which is about 10% higher than the same period last year. Even more important, the company's diluted earnings per share came in at $1.57, up 12% year over year. In simple terms, Apple is not only selling more, but also making more money for each share its investors own. This quarter was described as Apple's best June quarter ever. Growth wasn't limited to one product or one market. iPhones, Macs, and services all showed strong results, and sales increased across every region. iPhone revenue alone climbed around 13%, reaching roughly $44.6 billion, while services hit new record highs thanks to the App Store, iCloud, and subscriptions like Apple Music. That balance is key because it shows Apple isn't relying on just one engine to move forward. At the same time, Apple used the earnings release to highlight where it's investing next. Tim Cook emphasized artificial intelligence, making it clear that Apple will spend more in this area and is even open to acquisitions if they help strengthen products like Siri or bring new features to the ecosystem. This is a sign the company doesn't want to fall behind competitors in AI, which is becoming one of the biggest battlegrounds in tech. Of course, not everything was perfect. Apple faced $800 million in tariffs this quarter, and it expects that number to climb to around $1.1 billion next quarter. To deal with this, the company is actively shifting more of its manufacturing to countries like India and Vietnam. That's a costly adjustment in the short term, but it gives Apple more flexibility and protection in the long term. So, what's the conclusion? Is it time to buy Apple? Here's the honest answer. Apple is a premium stock, not a bargain. So, is it time to buy Apple? The numbers show the stock isn't cheap. With a PE above 30, it trades at a premium compared to its growth. But Apple keeps proving why investors pay that premium: record revenue, growing profits, strong iPhone and services sales, and massive free cash flow. It's not the stock that will double overnight, but it's one of the safest and most consistent companies in the world. If you're a beginner looking for stability and long-term compounding, Apple makes sense. If you're chasing undervalued bargains, this isn't it. It's worth remembering that this video isn't a recommendation. I just taught you how to evaluate a stock so you can do the same with any other stock you're considering investing in. That's it. Bye.